In today's fast-paced business world, financial data is more than just numbers on a page. It's the key to unlocking growth and making informed decisions. Welcome to Lesson 1 of Leveraging Financial Data for Growth. In this video, we'll explore how to harness the power of financial reports, analyze key metrics, and identify growth opportunities for your business. Financial data provides a window into the health of your business. By analyzing reports like profit and loss statements, balance sheets, and cash flow statements, you gain insights that can help guide your decisions, whether you're cutting costs, making investments, or planning expansions. There are 3 essential financial reports every business should use for decision-making. Profit and loss statement. This report shows your business's revenues and expenses over time. It's crucial for understanding profitability. For example, a retail store might analyze its P&L to see which products are underperforming, adjusting their strategy to increase sales. Balance sheet. This gives you a snapshot of your assets, liabilities, and equity. It helps assess your company's financial stability. A construction company might check its balance sheet to ensure they can fund a new project. Cash flow statement. This tracks how much cash is flowing in and out of your business. Managing cash flow ensures your business stays operational during lean periods, like a tech startup securing extra funding during months of negative cash flow. Financial ratios give you even more insights. Let's look at 3 key ratios. Gross profit margin shows how efficiently you're producing and selling goods. For example, a manufacturer might monitor a 40% margin to stay competitive. Current ratio tells you if you can cover short-term liabilities with short-term assets, helping businesses like restaurants ensure they're financially prepared for slower seasons. Debt-to-equity ratio shows how much debt your business has compared to its equity. Retail chains often evaluate this before taking on new loans. Beyond the present, financial data helps you plan for the future. Scenario planning and forecasting allow you to prepare for the best case, worst case, and everything in between. For instance, an e-commerce business can forecast future revenue using past sales data and adjust for seasonal trends. Meanwhile, a consulting firm might develop a worst-case scenario to prepare for a major client loss, allowing them to pivot quickly when challenges arise. Once you understand your financial data, it's time to focus on growth. Financial reports help you pinpoint your most profitable products or services, as well as identify top customer segments. For example, a landscaping company might discover that commercial contracts are far more profitable than residential ones, prompting them to shift their focus to that area. Similarly, analyzing market trends can help you explore new opportunities, like a fitness center investing in virtual classes based on rising demand. Lastly, make sure your business is ready to handle growth. Financial data can help determine if you have the resources to expand, whether it's investing in automation or hiring new staff. For example, a manufacturing company might invest in automation after identifying production bottlenecks that could prevent scaling up. Lesson 2, Managing Debt and Expanding Capital. Managing debt can be a balancing act, but when done right, it's the key to scaling your business. Today, we'll dive into responsible borrowing, smart debt repayment, and how to reinvest profits to grow your company without relying too much on loans. Let's get started. First, let's talk about responsible borrowing strategies. Debt can fuel growth, but borrowing without a clear plan is a recipe for disaster. Before you borrow, ask yourself, why do I need this loan? Borrowing should be tied to growth-oriented activities, not day-to-day expenses. For example, a bakery might take out a loan to purchase more ovens to meet rising holiday demand. This debt is directly tied to increased revenue. Remember, short-term loans are great for immediate cash flow gaps, while long-term loans are better for bigger projects, like expanding operations. From traditional bank loans for long-term projects to flexible lines of credit for short-term needs, choosing the right loan type is key. Don't forget about SBA loans, which offer favorable terms for small businesses. Now that you've borrowed responsibly, let's talk about repaying that debt. The goal is to avoid unnecessary interest costs and keep your business in the green. Start by paying off high-interest debt first. This is called the avalanche method, and it helps reduce the total interest you pay over time. For instance, a design firm might focus on paying off a high-interest credit card first before tackling a lower-interest equipment loan. Alternatively, there's the snowball method, where you pay off the smallest debt first for quick wins, helping you stay motivated. Next, create a debt repayment schedule. Set clear goals, automate payments, and make debt repayment part of your business budget. Sticking to a repayment plan helps you avoid missing payments and frees up capital to focus on growth. Finally, let's talk about reinvesting your profits. Instead of relying entirely on debt, reinvesting profits is a smart way to fuel sustainable growth. When deciding where to reinvest, focus on areas that will give you the highest return on investment. A software company might reinvest in upgrading their platform, or a fitness studio might spend on a new marketing campaign to attract more customers. Balancing reinvestment with debt repayment is key. Set a budget that allocates part of your profits to both growth and reducing your debt load. Monitor your cash flow closely and strike a balance that keeps your business growing without overextending your finances. To wrap things up, managing debt responsibly and reinvesting profits are two sides of the same coin. With the right strategies, you can grow your business sustainably without putting your finances at risk. Welcome to Lesson 3 of Dollars and Deductions, where we tackle one of the most crucial aspects of business expansion: maintaining financial health while scaling. Scaling is exciting, but if you're not careful, it can put immense pressure on your financial resources. In this video, we'll dive into managing cash flow, controlling costs, and scaling operations without sacrificing profitability. First, let's talk about cash flow. As your business scales, you might see increased sales, but more customers, more employees, and more inventory can mean that money flows out faster than it comes in. So, while it may look like you're growing on paper, your actual available cash could be another story. A construction company with a booming business but delayed payments from clients, showing cash flow strain even when profitable. Remember, profit does not equal cash flow. You need to track your cash flow regularly, especially during rapid growth, to ensure you can pay employees, suppliers, and other expenses. Without this, you could face cash shortages that disrupt operations. One way to stay ahead is by creating cash flow projections. Forecast your expected sales, inventory purchases, payroll, and other expenses. An online retailer preparing for the holiday season by increasing inventory while managing expenses based on projected cash flow. By regularly updating your projections, you can identify when cash shortages might occur and take action before they happen. Think of this as your financial roadmap to navigate growth. Even with great planning, cash flow gaps can happen. That's where short-term financing solutions, like lines of credit or invoice factoring, come in handy. A restaurant using a line of credit during a busy holiday season to cover increased costs until sales revenue kicks in. These tools give you liquidity without the burden of long-term debt, but use them wisely. You don't want to over-leverage your business with too much debt while you're growing. Now let's move on to another critical aspect of scaling: how to grow without losing profitability. As you expand, your costs will increase, but you need to keep those costs under control to ensure your growth doesn't eat into your profits. A logistics company investing in fuel-efficient vehicles to keep operational costs down as their fleet grows. Always be strategic with your spending. Avoid unnecessary overhead costs and invest in areas that will directly contribute to efficiency or revenue. Another key area to watch as you scale is your pricing strategy. You might need to adjust your prices to reflect the increased value you're delivering or to cover higher costs. A software company adding new features to its product, allowing for a strategic price increase that maintains profit margins. By revisiting your pricing periodically, you ensure your growth doesn't come at the cost of profitability. To wrap up, here are the key takeaways. Monitor your cash flow closely during growth, create detailed projections, use short-term financing wisely, control costs, and adjust your pricing strategy as you scale. Remember, the goal is not just growth, but profitable growth. Thanks for watching! In the next lesson, we'll discuss how to optimize your business's financial strategy for long-term sustainability.